This week, landing Saturday, we have 3 exciting webinars lined up for you. At 10 a.m., we have the new fixed income playbook, strategies for a falling interest rate cycle. At 11 a.m., we have Zero to Investor, how to start investing from our very first salary. And finally, we have Anchor Awaits, India's sport and logistics sector. To join this webinar, kindly click the registration link in the description.
The November review of BoringStocks index is here. If you had invested 1 lakh rupees in the BoringStocks index on the 1st of November, on the 30th of November, your portfolio would be worth 1,02,029. That translates into a return of 2.03% for the month. If you chose to invest in the Nifty 50 TRI during the same period, your 1 lakh would have become 1,01,758, translating into a return of 1.76%. So, we have a very marginal outperformance over the Nifty 50 TRI in November. But remember that it has been a very, very strong market in November and particularly strong for the Nifty 50. In the month of November, 2 stocks in the BoringStocks index returned negative. You had ITC giving minus 2.34% and Coal India returning minus 0.54%. So 8 stocks in the BoringStocks index gave positive returns. But did these 8 stocks actually give higher returns than the Nifty 50 TRI? Did the stock at an individual level outperform the Nifty? Now remember one data point, the Nifty returned 1.76% in the month of November. Let's see what each stock did. HDFC Bank, 1.51%. Then you have Bharti Airtel, 1.33%. Then you have Maruti Suzuki, 1.59%. And lastly, you have Britannia Industries, 0.44%. So 4 stocks amongst these 10 boring stocks did not beat the Nifty 50 TRI. So it was left to the balance 4 stocks to deliver all the returns, and those 4 stocks did all the heavy lifting in the BoringStocks portfolio. Which are these 4 stocks? You have Reliance Industries that delivered 5.58% returns. You have ICICI Bank delivering 3.15% returns. Then you have Larsen & Toubro delivering 2.24% returns. And lastly, you had Sun Pharma delivering 7.34% returns in a month. So these 4 stocks did the heavy lifting and helped the BoringStocks index beat the Nifty 50 TRI. The way I just did this exercise can also be done in your own portfolio. If you are benchmarking your portfolio against any index, you know the index return in the month. See how the stock returns have been during that month. That tells you whether the stocks have been weak, neutral, or far stronger than the index. How does this help? It gives you a sense of what is driving your portfolio. It gives you a strength. It gives you an analysis of where strength is coming inside your portfolio. It tells you where your portfolio is weak. Now, if you understand this clearly, you will know where strength has to hold on, where weakness has to turn to strength, and where performance will come in the future, because you will try to understand the companies better. And when you understand the companies better, you will do your expectation setting better. And when you do your expectation setting as accurately as possible, and if your expectation setting is right, then your portfolio will start delivering outperformance. So outperformance is definitely a function of your understanding of where returns can come within your portfolio. It's very, very important. It's far more important than most of us think or realize. Now let's see what has happened to the BoringStocks portfolio from January 1, 2025 till November 30th. If you invested 1 lakh in the BoringStocks index on January 1st, it became 1,15,201 rupees on November 30th, delivering a return of 15.2%. These are simple returns. If you put the same money in the Nifty 50 TRI, it became 1,11,733, delivering 11.73% returns. So this year so far has actually been good for the Nifty. Remember, the long-term average return of the Nifty is 12%. Whether you look 30 years, 25 years, 20 years, 15 years, 10 years, 5 years, the long-term average has been around 12%. The fact that in a very tough year, the Nifty has still returned 11.73% over 11 months shows that it's been a very decent year for the Nifty 50. But has it been a decent year for us in our portfolios? Depends on whether our portfolio was large cap centric or more a flexi cap centric approach with heavy weightage for mid and small, whether it was a growth driven approach or a value driven approach, how these two styles blended inside your portfolio, all these things matter. Now, benchmarking is not a holy grail, but still it tells you where you stand. It tells you what you should improve upon. It tells you why things worked or didn't work in your portfolio. It helps you adapt all the time, and it helps you grow beyond the benchmark. If you want to beat the benchmark, there's no harm in understanding what is happening in your portfolio in relation to the benchmark. But if you're an investor who is the type who takes deeply contrarian bets, then benchmarking is not for you. Because you have to give time for contrarian ideas, and if you're going to look at it every month or every quarter, it won't work. And your returns are always going to be extremely lumpy, and when you are very successful, you're going to beat the benchmark anyways. These are thoughts that I want you to keep in your mind when you study your own portfolio. The idea is not to showcase any style as superior. The idea is to develop an understanding of how to create your own investment style, how to fashion a style which is conservative and still successful, and how to do risk management better all the time. That's the core need which made me create this index and publicly evaluate it every single month. The journey is 35 months old. If you started with 1 lakh on January 1st, 2023, after 35 months, your 1 lakh is worth 1,92,479, translating into a 92.48% return. That's a simple return. So your compounding is much better. I would encourage you to do the compound returns and probably post it in the comment section. If you put the same money in the Nifty 50 TRI, your 1 lakh becomes 1,49,827, translating into 49.83% returns. Again, exceptionally good. In 3 years or little under 3 years, 49.83% return in the Nifty clearly beats the Nifty's own long-term track record. But choosing wisely can give better returns. Choosing wisely and staying invested long enough can actually improve those returns. And betting with higher conviction on an idea, even if it is a large cap, can deliver alpha and significant beta. These are the lessons which we learn together in this BoringStocks index experience. I'm not making the BoringStocks as an investment recommendation. It's a learning exercise. Do keep that in mind while you make your investment decisions in your portfolio. And thank you for staying on this journey with us. Stay on. Let's learn together.